Joining us is Yardeni Research President Ed Yardeni. So, Ed, the market is actually not doing terribly with the fact that we've had a rapid shift in Fed expectations in the last few weeks, now thinking about a June hike, maybe even a July hike. What do you make of that?
Well, I think the market has been remarkably resilient, mostly because the economy has been remarkably resilient. My thesis here is that the pandemic was a big shock to all of us. It was different. None of us experienced anything like it. The last time in history, we had something like it was the Spanish flu in 1918. So it was a big shock. And now that the pandemic is basically over, there's still shockwaves from it. And yet there's some very substantial shock absorbers that have cushioned the economy from falling into recession.
Hey, Ed, it was fun to read some of your stuff over the weekend in which you said that parts of your Roaring '20s thesis remain intact, although I remember a few weeks ago where you did say another hike would make you pretty nervous. Has that gone away?
Yeah. No, it hasn't gone away. You know, I have to be realistic about the opportunities and the risks in this market. So I'm not going to kind of take one position here and tell you that nothing can go wrong. I mean, I have to, since I am an optimist and a bull in this environment, I have to be very well aware of what could go wrong. I think the Fed has got to be pretty close to done. I think that the banking crisis demonstrates that we are in restrictive territory. Jerome Powell basically acknowledged that a few days ago, that we are in restrictive territory. And what they really wanted to do is get it up to restrictive and keep it there. They didn't want to keep raising interest rates until something really seriously breaks and then be forced to lower interest rates. So I think they're where they want to be, and I think they're going to keep it here.
When you talk about shock absorbers, are you talking about fiscal policy? Just the enormous stimulus we've had, the legislation around infrastructure and that sort of thing? Because what I hear is that definitely works against the recession idea, but the excess savings do wear out by the end of the year.
Well, there's still a tremendous amount of liquidity in the system. Some of it is very visible in M2, which is still about $500 billion above its pre-pandemic trend line. We know that there's excess saving, and it's very likely that excess will end by the end of the year, as you point out. But meanwhile, the labor market continues to generate jobs. Meanwhile, we're seeing that wages are actually starting to increase faster than prices. And then another important shock absorber is the baby boomers. I'm one of that group, so I know what we're doing. And I'm still working for a living, but a lot of my friends are retiring. And they're getting pension benefits. They're getting 401k payouts. They're getting Social Security. And they got a lot of time to spend the money on early bird specials at the diner. And they're traveling a lot. I know that from what friends are doing.
Not to mention a lot of home equity. One thing, Ned, that you did mention was that rent inflation is moderating pretty fast, and you think that's going to continue through the course of the year, right?
Absolutely. We have, as you know, we've got these monthly coincident indicators of rent that are showing what current leases are doing, and that inflation rate's coming down substantially. And that really is a good leading indicator for the rent measures in the CPI and in the PCED. So I think that's coming down. I think durable goods inflation is going to be zero for the foreseeable future. So I think we need to see some moderation in other services, and I think we will.